All right, my friends, listen closely, because what's happening in silver right now is the kind of move that doesn't knock politely. It kicks the door in. We're watching a market that spent years being laughed at, ignored, and managed suddenly start behaving like it has a mind of its own. And the scary part? The loudest signals are not coming from headlines. They're coming from the places where real metal has to show up on time. As you're watching this, New York silver futures have been trading in territory that used to sound like fantasy. We're talking about prices pushing above the mid-90s. Meanwhile, if you convert what's happening in Shanghai into comparable terms, you're looking at silver priced even higher, with levels that effectively put it above $100. Now stop right there and let that settle. Because whenever one major hub is pricing metal higher than another, you don't just get a cool chart. When you get stress, you get pressure. You get a tug of war over physical supply. And when that tug of war starts, it rarely ends quietly. Before we go deeper, I need one quick favor, because my analytics are screaming something at me. A huge chunk of you watch these videos to the end, but you still haven't subscribed. If you value the work John A.G. is doing here, hit subscribe and drop a quick comment, even our John A.G., so the algorithm knows this channel is worth pushing. All right, now let's connect the dots. If you've been following the silver story at all, you already know that the real game isn't just paper contracts. It's the physical flow between vaults, refineries, manufacturers, and the places that promise delivery. Last autumn, London gave us a warning shot. We saw a supply strain show up there, the type that gets downplayed until it can't be hidden. That tension didn't fully explode into chaos at the time, partly because extra metal was pulled in from outside silver that moved out of China and out of the United States to relieve the pressure in London. But here's the question almost nobody asked out loud. If London had to be rescued by pulling supply from other regions, what happens to those regions after the rescue? That's where this story gets wild, because while London was catching its breath, the visible silver inventories in China were already moving in the wrong direction. The data has been showing a drain, and lately that drain has looked like it's approaching the perilously thin category. In plain English, the cushion is getting smaller. Some people hear a little over 1,000 tons and shrug. But when you translate the numbers into ounces, it becomes easier to feel the reality. We're talking about vault totals on the order of a few dozen million ounces. That might sound big to a normal person. In a world where industrial demand eats silver like oxygen, it can be frighteningly small. And that's why the next development matters so much. A couple of weeks ago, we started hearing reports that manufacturers in India, especially the ones tied to solar panels, weren't just shopping like normal. They were reportedly reaching beyond their usual suppliers and dialing up producers in Latin America, trying to lock down supply directly. The message was basically, we'll pay above the benchmark. We need metal, and we need it now. The premiums being discussed were not pennies. They were described as being in the range of roughly $8 to $10 over the COMEX linked benchmark. And the reason given was simple, almost blunt. China is soaking up silver, and it's making it harder for Indian manufacturing to source what it needs. Now, when you hear that, you might think, okay, interesting rumor. But then the market did what it always does when a rumor is real. It confirmed it through premiums, because just recently, dealers in India were reported to be charging sharply higher premiums on precious metals. Gold, which had been trading with discounts not long before, flipped to strong premiums above spot. And silver premiums in India? They surged to roughly $8 an ounce above the benchmark, surpassing earlier spikes. Let me slow down and make sure you understand why that's a big deal. The benchmark price is the headline price. It's the one people argue about online. Premiums are the extra cost real buyers pay to actually receive metal in hand, on time, in deliverable form. When premiums rise, it's not because people are bored. It's because inventory is tight, delivery is constrained, or demand is pulling supply faster than it can be replenished. So when you see Indian silver premiums surge to around $8, you're not looking at noise. You're looking at a stress fracture. And here's where the story starts to feel like a thriller. Because the last time India had a major premium spike, the aftermath wasn't minor. There was a moment when Indian silver ETFs reportedly had to halt or pause adding new silver because they simply couldn't source enough physical to keep expanding. And shortly after, London faced its own episode of silver strain that became impossible to ignore. So now ask yourself this. If New York is high, Shanghai is higher, London has already had a scare, China's visible supply is thinning, and India is paying up. What happens if one of these hubs faces a fresh shortage event? That's not a hypothetical for entertainment. That's the type of question that decides whether silver moves in a controlled stair-step or a violent repricing. And here's the part that makes this even more explosive. Industrial demand doesn't wait patiently for a better price. If you are a manufacturer and your supply chain stalls, you don't just lose a little profit, you lose contracts. You lose deadlines, you lose reputation. In industries like solar, a delay isn't just expensive, it can be fatal. So when manufacturers start paying huge premiums, it's often because they're buying insurance. They're paying extra today to avoid disaster tomorrow. Which means the premium spike is not just a number, it's urgency made visible. Now, I want to give you a quick cliffhanger before we go further, because in a minute, we're going to talk about the one decision hanging over markets that could pour gasoline on all of this. And when you see that connection, you might understand why the next move could be faster than people expect. But first, quick reminder. If you want daily posts, instant updates, and my personal takes that I don't always put into these public videos, there's a WhatsApp channel link in the description. Join it. I drop premium notes there, including voice updates and fast commentary that moves quicker than YouTube. All right, let's get back to the pressure map. We have three major arenas in this story right now: the Western Paper Hub, the Asian Physical Pull, and the global delivery network that connects them. New York is where futures trade and where the world watches the screen. Shanghai is where pricing can reflect local demand and supply realities, and where metal flows matter. London is a key delivery and vault center where shortages can echo across the globe. And India, quietly, is a demand engine that can suddenly become loud when manufacturing and investment buying collide. When these regions start flashing warning lights at the same time, it doesn't mean guaranteed crisis, but it does mean the probability of a surprise increases. And in markets, surprises are what create viral moments. Now, here's the legal and political spark sitting in the background. There's a major court decision looming tied to the structure and legality of certain tariffs associated with the Trump era. Prediction markets have been assigning odds, and at points those odds have implied that the outcome could go against the tariffs with a greater than 50% probability. In other words, there's a real chance the system gets knocked sideways. And if the ruling goes against the tariffs, the financial implications have been described as massive, so massive, that even discussing the numbers becomes a problem. The idea is that the money involved would be so large, it would take years to untangle what's owed, where it goes, and how to settle it. Now, whether you love that or hate that, politically doesn't matter for this video. What matters is what markets do when the rules suddenly look unstable. They run, they hedge, they rush into what feels real. And right now, with gold printing fresh highs and hovering within range of the next major psychological milestone, the stage is set for metals to benefit from that kind of fear. In fact, gold has been trading so close to a gigantic round number that it's almost teasing the market. And when gold gets that close to a major level, people who never cared start caring. It becomes dinner conversation. It becomes headlines. It becomes trend. And when gold becomes trend, silver rarely stays quiet. Now, if you're still with me, here's your first engagement question, and I want a real answer in the comments. Do you think the bigger signal is the futures price in New York, or the physical premium spike in India? Because one is a screen price, the other is what people pay when they must have metal. And here's your second question. If China's visible inventories keep sliding while India's manufacturing demand keeps rising, where do you think the next bottleneck shows up first? London, Shanghai, or India? Drop your take below. I read these, and it helps me decide what to cover next. Now let's address the thing a lot of people get wrong in a market like this. They look at a high price and assume demand will vanish. That's sometimes true for luxury demand. It's often not true for industrial demand. Industrial demand is driven by necessity and timelines, not vibes. So if silver is a key input and you're producing something that has to ship, you don't get to wait for a dip forever. Eventually you pay the premium or you shut down. And if enough buyers are forced into that corner at the same time, that's how the physical market starts pulling away from the paper market. That's also how narratives break. Because for years, people have been told that the paper price is the price. Premiums and shortages are dismissed as local issues. But when those local issues appear in multiple regions, the dismissal starts to sound like denial. Now, I'm going to say something carefully. I'm not claiming a global silver shortage headline has officially been stamped today in every market. What I am saying is that multiple canaries are wobbling, and historically, when canaries wobble across several rooms at once, you don't ignore it. You watch the exits, you watch the vaults, you watch the premiums, and you watch how quickly the story spreads, because once the public catches on, the game changes. At this point, let me add a friendly reminder that builds the community. If you've had a win, maybe you caught a move, maybe you built a business, maybe you hit a personal milestone, share it in the comments. Your success story can lift somebody else who feels stuck, and it also tells the algorithm this community is alive. And now, as promised, here's a quick creative shout out inside the flow. If you want to hear silver-related success stories, real stories of people who made money and what they did differently, there's a link in the description to another channel. Go subscribe there too and watch how others built results. It's worth it. All right, back to the main thread, because the next section is where the tension tightens. Let's talk about spreads. When one region prices silver meaningfully higher than another, traders, refiners, and large players notice. That gap creates incentives for metal to move. But metal doesn't teleport. It has to be sourced, refined, transported, insured, and delivered. And every step introduces friction. When inventories are healthy, that friction is manageable. When inventories are thin, friction becomes delay, and delay becomes premium. So an Indian premium spike doesn't exist in a vacuum. It can be an effect of global flows tightening, or it can become a cause that pulls metal away from other hubs. And here's a cliffhanger to hold on to. If India keeps paying up and China keeps pulling supply, what do you think happens to London the next time delivery demand spikes? Because London is the bridge between worlds. When the bridge shakes, the whole system feels it. Now, let's talk briefly about psychology, because virality is not just information. It's emotion. Silver is a market that humiliates people for years, and then rewards patience in a way that feels unreal. That creates a powerful setup, disbelief turning into shock. And shock is what people share. When silver is boring, almost nobody forwards a link. When silver is ripping and premiums are exploding, everybody starts texting each other. That's why these moments matter. Now, I want to be transparent about how to navigate this without getting played. In a fast market, you will see two types of content explode. One type screams, sell now or you're doomed. The other screams, it's going to the moon tomorrow. Both are designed to steal your focus. Instead, focus on measurable signals. Premiums, inventory changes, delivery delays, and cross-market gaps. Those are harder to fake, and they matter to real buyers. Now, we're approaching the part where I need to deliver on a promise to the most serious supporters. By the time you're watching this, there should already be a members-only video published. That video pulls the full set of updates into one place and goes deeper than I can go here. More context, more connections, and more in-depth analysis. If you're really following closely, join the membership and watch it. It's also the easiest way to identify who is truly locked in. All right, let's bring this back to the present, because the market is moving and the timeline matters. We have a situation where New York is printing prices above the mid-90s, Shanghai is effectively higher, and physical markets are showing stress via premiums. Gold is also pushing into historic territory and hovering within striking distance of a major round number milestone. And there's a looming legal decision risk that could inject more uncertainty into currencies and trade. That combination is not normal. By style. And when markets stop being normal, the next move often comes when the crowd least expects it. So let's game out two paths. Path one, the physical tension eases, metal flows increase, premiums cool, and the market consolidates. Path two, another hub hits a snag delivery delays, inventory drawdowns, or a sudden surge in demand and premiums jump again, pulling attention from the public and forcing more buying. Both paths are possible. But the fact that we're even having this conversation tells you the risk profile has changed. Now, here's another cliffhanger that might be the most important one. If the court decision triggers chaos and the dollar market gets rattled, do you think investors will rush into bonds or into hard assets they can't print? Because when confidence cracks, people don't ask polite questions. They move. And if that movement collides with industrial demand, silver becomes a very small door with a lot of people trying to run through it. Now I'm going to end with a clean, direct call to action because I'm running a campaign and I need your help. We're pushing back against copycat content that recycles the same material and waters down the space. If you want to support this campaign, do three things right now. Subscribe, hit like, and leave a comment. Again, even our John AG. That one little comment helps more than you think. And don't forget the WhatsApp channel in the description for instant updates, voice notes, and posts you won't always see on YouTube. Now, tell me in the comments, where do you think the next pressure point breaks? London, China, or India? And do you believe the real signal is the paper price? Or the premium people pay to get physical today? I'll see you in the next video. Now, let me paint the scene the way it looks if you're not staring at a trading screen all day. Silver isn't just an investment. Silver is an ingredient. It's in electronics, it's in medical components, it's in clean energy supply chains, and yes, it's in solar. That means silver has two personalities at the same time. On one side, you have investors, traders, and funds trying to front-run the next move. On the other side, you have businesses that don't care about your chart patterns because they have purchase orders and deadlines. And when both sides decide they want the same limited pool of metal at the same time, the market stops acting like a textbook. It starts acting like a squeeze. So when you hear silver near the mid-90s in New York, don't only think, wow, that's high. Think about what that does to every link in the chain. Refiners have to hedge, dealers have to restock, manufacturers have to secure supply, and everyone has to decide whether they want to gamble that next week will be easier. Here's what makes this moment so different from the sleepy years. For a long time, the paper market could dominate the conversation because physical availability felt abundant enough that shortages were rare, local, and short. But once physical flow becomes tight in more than one region, the paper market has a harder time convincing the world that everything is fine. That's when premiums become the truth serum. Because you can debate a futures print, you can debate a headline, you can debate a chart, but you cannot debate a dealer saying, pay the extra or you don't get it. That's why the Indian premium number matters so much. An $8 premium is not a casual detail. It's a neon sign that screams, we need supply, and supply isn't showing up the way it used to. Now, I want you to notice something subtle that most people miss. A premium spike can happen for two reasons. Reason one, demand surges suddenly, so buyers are bidding up the same inventory. Reason two, supply tightens suddenly, so the same demand is competing for less product. In reality, the worst moments happen when both are true at the same time. And based on the chain of events we've been watching, London strain last autumn, metal pulled from elsewhere, China inventories draining, India manufacturers calling producers directly. This looks like a system where both demand pressure and supply constraints are present. That's why people are on edge. Now, here's another attention point. The story is not just India. India is the loud headline today, but the real story is the relay race between markets. When London needs metal, it pulls from somewhere. When China needs metal, it pulls from somewhere. When India needs metal, it pulls from somewhere. And somewhere is not infinite. At some point, the pulling starts to collide. And when pulling collides, the market has to reprice to ration supply. That's not drama. That's how commodities work. Now, let's talk about the COMEX benchmark for a second, because it matters to understand why an Indian premium over COMEX is a flashing red light. The benchmark is a reference point. It's not a guarantee that you can walk into any country, pay that number, and walk out with physical metal. It's a financial price discovery mechanism that often reflects paper volume more than physical scarcity. So when physical markets start quoting big premiums over that benchmark, it's basically the physical world saying, your reference price is not enough to get the job done. That's when the two worlds begin to drift. And if the drift gets large enough, that's when the headlines shift from silver is up to silver is unavailable. And the second that phrase appears, the crowd changes. Let me make this visual. Imagine you're running a solar manufacturing line. You have contracts, you have deadlines, you have workers, you have machines, and you have one missing ingredient, silver. If you don't secure that silver, the entire line slows down. The cost of a delay isn't just pay a little more. It's penalties. It's missed shipments. It's losing future business. So what do? You pay the premium. You call producers directly. You call outside your usual network. You try to secure supply before your competitor does. That behavior alone can create the very tightness you were trying to avoid. Because once one buyer does it, the next buyer panics and does it too. That's how premium spikes become self-reinforcing. Now, let's rewind to the earlier sign that made many people uneasy. There was already a visible episode where India's silver investment vehicles, especially ETFs, were reportedly forced to pause adding metal because they ran out of available supply to acquire in size. That's not a normal situation. That's a stress scenario, and when that happened, it didn't stay contained. Soon after, London began to show strain. So if you've been paying attention, you know this isn't the first time the system has creaked. It's just that now, the creaking is happening in multiple corners at once. And this is where I want to drop another cliffhanger. Because when markets creak, they can either stabilize quietly, or they can snap loud. And the snapping often happens when a new buyer shows up unexpectedly. So here's the question. Who is the next unexpected buyer? Is it industrial demand getting stronger? Is it funds rotating out of something else? Is it retail investors suddenly waking up because they saw a viral clip? Hold that thought. Now let's talk about the two prices problem again, because it matters for what comes next. If Shanghai is effectively pricing silver higher than New York, then the incentive is for physical metal to move toward the higher paying region. But in practice, you can't just drain one vault and refill another like you're pouring water. There are contracts, there are regulations, there are shipping and insurance delays, there are refining requirements, there are quality specs, and there are time lags. So when a gap exists, the market can't instantly erase it. Instead, the market often responds with premiums, because premiums are the tool used to pull supply faster. This is why India's premium jump is so important. Premiums are the market's way of saying, we need to pull metal now, and we're willing to pay. Now let's pull in the gold side briefly, because it adds fuel to the psychology. When gold swings from being offered at a discount to being offered with a heavy premium, it's a sign that local demand has shifted rapidly. It can also be a sign that dealers are protecting themselves because volatility makes inventory risky. When price moves fast, dealers don't want to sell out today and buy back tomorrow at a higher cost. So they raise premiums. That's risk management. But the knock-on effect is that it further tightens the physical market. And once gold demand is intense, silver demand often gets pulled along because people treat silver as the smaller, faster cousin. That perception drives waves of buying. Now, let me address the court decision again, because this is not just politics, it's market structure. When traders and businesses can't predict trade rules, tariffs, and legal outcomes, they hedge. They move cash into safer assets. They stockpile inputs. They shift inventories. All of that increases demand for commodities and hard assets, even before anything bad officially happens. So if a major ruling is looming, and one prediction market is pricing the odds of the tariff surviving at roughly about 1/3, that means a lot of people believe a disruptive outcome is more likely than not. And disruption is a catalyst. In the disruptive scenario, people rush to protect themselves. In the protective rush, they buy gold, they buy silver, they buy commodities. And that rush can collide with the already tight physical supply. That's when you get the kind of move that turns a niche market into a global conversation. Now let me give you a quick recap, because retention is about clarity. Here's what we have on the table. New York futures have been trading above the mid-90s. Shanghai pricing has been effectively higher, pushing above 100-plus territory. London has already experienced a supply strain episode in the recent past, eased partly by importing supply from other regions. China's visible vault inventories have been trending down toward roughly the low 30 millions of ounces, which is thin in the context of global industrial demand. India's manufacturers have reportedly been calling producers directly and offering massive premiums to secure supply. And now Indian silver premiums have been reported around $8 an ounce over the benchmark, beating earlier peaks. That's the chain. And chains matter because a break in one link doesn't stay local. Now, you might be asking, okay, but what does this mean for someone sitting at home? It means that the risk of a sudden repricing event increases. It means the market becomes more sensitive to headlines, rumors, and small shifts in demand. It means the difference between paper price and street price can widen. And it means that if you're trying to buy physical, you might feel it in availability and premiums before you feel it on the chart. That's why I keep coming back to one principle. Follow the physical market signals, not just the screen, because the screen can lie for a while. Physical conditions can't. Now let's talk about the can it cool off question. Yes, it can. Commodities can spike and then consolidate. A premium can jump and then ease. Markets can breathe. But when multiple regions are showing tightness at the same time, the cooling off often happens only after a repricing has already occurred. In other words, relief tends to come after the pain, not before it. That's why the next few weeks matter. And if you want to be plugged into those week-to-week shifts, again, join the WhatsApp channel in the description. That's where I drop quick updates, instant voice notes, and my personal analysis when things move too fast for a full video. Now, let's bring in the element of crowd behavior, because this is where virality lives. Most people don't pay attention to silver until they feel like they missed something. They ignore it at $20. They ignore it at $30. They argue at $40. They start asking questions at $60. And by the time it's in the 90s, the question isn't, should I learn about silver? It's, how did I not see this coming? That emotional shift creates clicks. It creates shares. It creates panic buying. And the internet amplifies it. So the market isn't just fighting physics, it's fighting psychology. Now, I want to say this in a way that respects reality. A lot of mainstream voices will try to frame premium spikes as temporary or local. Sometimes they are. But the reason the mainstream often downplays it is because the mainstream prefers narratives that don't challenge the financial system. A physical premium spike is a challenge. It says the benchmark price is not the full truth. And that's uncomfortable for people who want everything to look stable. So when you see premiums rising, don't let anyone hypnotize you with the idea that it's meaningless. It might be the earliest signal you get before the broader public catches on. Now, let's lean into one more cliffhanger, because there's a specific scenario that could make this go from tight market to front page. If one of the key vault hubs, especially a hub used for large-scale deliveries, experiences a sudden wave of delivery demand at the same time supplies are thin, you can get a scramble. In a scramble, premiums explode. In a scramble, spreads widen. In a scramble, the paper price becomes a suggestion. And in a scramble, you start seeing words like allocation, delays, and limited supply. If you've been around metals long enough, you know those words change behavior instantly. Now, I'm going to talk directly to the community for a second. If you want to help build a stronger community and also help this content compete against recycled copycat material, you can do it in under 5 seconds. Subscribe, like, comment. Even a single phrase like "our John AG" is enough to tell the system you care. That's how we win the distribution battle. Now, let's zoom in on India again, because the India signal is not random. India is massive in precious metals culture, but what's changing is the role of manufacturing demand. When manufacturing demand rises, it can turn a seasonal demand market into a steady demand market. And steady demand is powerful because it doesn't disappear overnight. Now combine that with industrial sectors like solar that are expanding and competing for inputs, and suddenly India is not just buying because of festivals or investment sentiment. India is buying because factories need silver to function. That's a different type of demand. It's less emotional, more structural. And structural demand, when it hits a tight supply environment, tends to force repricing. Now, if you're wondering why the premium number matters relative to earlier peaks, it's because earlier peaks were already high enough to cause disruptions. If the previous spike was around $5 and it was linked with product additions being halted, then an $8 premium signals the pressure has returned and potentially returned stronger. And when pressure returns stronger, it tends to travel. That's why I keep using the word echo, because these markets echo off each other. Now, I want to take a moment to make sure we're not falling into the trap of thinking this is just bullish hype. There are risks, there is volatility, there are pullbacks, there are fake-outs. In fact, when a market becomes popular, it becomes a hunting ground for emotional mistakes. That's why it's important to focus on process. Watch the premiums, watch the spreads, watch what the physical market says. And don't let short-term noise trick you into making long-term decisions in a panic. Now, here's a question that I want every serious viewer to think about. You can answer it in the comments too if you want a second engagement wave. If premiums are rising, even when the paper price is already high, does that suggest demand is strong? Or that supply is weaker than people admit? Because in a normal market, high prices usually cool demand. In a stressed market, high prices don't cool demand, they reveal how desperate demand is. Now, since we're talking about engagement and community, let me repeat this because it genuinely helps. If you have a success story, share it below. It doesn't have to be, I became a millionaire. It can be, I started investing, I started a side hustle, I paid off a loan, I improved my income, anything. When people see real humans making progress, it raises the whole room, and it also makes these videos more discoverable. Now, I promised earlier we'd talk about what to watch next, and this is the part that keeps people ahead of the crowd. Watch for whether Indian premiums stay elevated or fade quickly. Watch whether Shanghai continues to hold a higher effective price than New York. Watch whether reported vault inventories in China stabilize or keep draining. Watch whether London shows any signs of renewed strain, even subtle ones. And watch the legal decision timeline, because a surprise ruling can shock markets faster than any economic report. Now, here's the scary truth. When a market like silver gets hot, it can move in ways that feel unfair. It can gap up overnight. It can rip higher on a weekend headline. It can smash through resistance like it wasn't there. And then, just to punish emotional buyers, it can pull back sharply before ripping again. That's why retention matters in your own thinking. You need to stay calm while others swing between euphoria and fear. Now let's tie this to gold's position near that massive milestone. When gold approaches a giant round number, it does two things at once. It attracts attention from people who don't normally care, and it forces short sellers and skeptics to reassess. That reassessment creates more buying, which can create more momentum. And when gold is in that mode, silver is often dragged into the spotlight as the cheaper alternative that has more upside in percentage terms. That narrative is not always rational, but it is powerful. And powerful narratives drive flows. Now, I want to add one more piece of texture to this story because it's important. When silver moves like this, some people assume it's only investors. But the industrial world doesn't get press conferences. Manufacturers don't make viral tweets about their procurement teams. The only clue you get is premiums and sourcing behavior. So when you hear that manufacturers were calling producers directly and offering big premiums, that's not a meme. That's procurement reality. And procurement reality is often the earliest stage of a broader squeeze. Now, we're heading toward the final stretch, but I don't want you to lose the main point. The main point is not silver is up. The main point is silver is stressed. Stress can resolve in two directions. It can resolve with supply catching up and easing premiums, or it can resolve with price rising enough to ration demand and pull more metal into the market. But either way, stress means movement. Now, one more time, because this is a must. If you want the fastest updates, join the WhatsApp channel in the description. If you want the deepest updates in one place, join the membership and watch the members-only video that's already up. And if you want this channel to keep beating recycled content, subscribe and comment rjohnAG. All right, now, final cliffhanger. If one more region gets tight at the same time the court ruling shocks markets, we could see the type of move that makes everyone suddenly claim they were bullish all along. And you know what that means. The window of being early closes fast. So tell me right now in the comments, are you watching the paper price or are you watching the premiums? And if you had to guess, where does the next break show up, India, China, or London? I'll see you in the next one. And if you're new here, don't just watch quietly. Join the conversation. Your comment is a vote for original work, and your subscription is the fuel. Let's build something real together, starting today, and keep this community strong weekly.